So, it's not every day you look at a struggling commercial real estate firm and an electric vehicle charging startup and realize they are running like the exact same survival play.
Right. On the surface, it makes zero sense.
Exactly. But today, we're digging into a stack of your financial sources to uncover exactly that. We were working off this really fascinating stack of recent market research, financial notes, and specifically the Q4 2025 earnings called transcripts from two wildly different companies.
Yeah, wildly different is an understatement.
For real. On one side, we have Brandywine Realty Trust, and they're an office REIT, so real estate investment trust managing physical skyscrapers. And on the other side, we have Blink Charging, which is a digital network EV infrastructure company.
Which, like you said, sound like they belong in completely different universes. I mean, one is pouring concrete and managing these multi-year office leases, and the other is deploying hardware and software for the global energy transition.
Yeah, completely different worlds. But our mission for this deep dive is to look past those surface differences. We are going to uncover the hidden universal survival and transition playbook that completely different companies are currently using to navigate a pretty brutal macroeconomic climate.
It really is brutal out there right now.
It is. So if you're looking at your own business or your own investment portfolio right now, understanding how these companies are pivoting from bleeding cash to, setting themselves up to actually thrive is essential. Okay, let's unpack this.
Let's do it.
We have to start with the first phase of the survival playbook, which is aggressive structural downsizing. It's the art of the hard pivot.
Right, because before you can even think about rebuilding a company, you have to stop the bleeding.
Yeah.
And you have to do it structurally, not just superficially. Like, you cannot just trim the edges. You have to alter the foundation.
And Blink Charging's Q4 transcript is just a perfect case study for this. They rolled out this initiative called Blink Forward, and the sheer scale of the cuts is severe.
Oh, absolutely.
I mean, they went in and aggressively downsized, cutting their global headcount from roughly 600 people down to
fewer than 300. Yeah,
exactly. Fewer than 300. They practically cut the company in half.
It's a massive reduction. But what's fascinating here is the difference between panic cutting and structural realignment.
Right. Tell me about that difference.
So panic cutting is when a company slashes marketing or fires customer service reps just to survive the next quarter's earnings call.
Like putting a Band-Aid on a bullet wound.
Yeah, exactly. And that usually destroys long-term value. Structural realignment, which is what Blink executed, fundamentally alters the cost baseline.
Because they fundamentally changed their operating model, right?
Right.
They didn't just fire half their staff and demand everyone else work 80-hour weeks.
Precisely. Specifically, they entirely exited in-house manufacturing.
So they essentially outsourced the headache.
Exactly.
Yeah.
They shifted to contract manufacturing using partners in the US and India.
Oh, wow. But they keep the IP, right?
Right. They still keep all their intellectual property. So the proprietary hardware designs, the firmware, the network software, they keep all of that. But they eliminated all the physical overhead of actually running the assembly lines.
Which is huge.
It's massive because by moving to contract manufacturing in places like India and the US, their core cost to produce a single charger might actually remain similar, but they suddenly don't have to carry the immense burden of managing an entire supply chain.
Or forecasting hundreds of individual raw materials.
Exactly, or paying for factory upkeep and insurance and all that.
And when you look at the transcript, the financial impact of removing that burden is incredibly clear. Their Q4 adjusted operating expenses dropped 32% down to $17.1 million.
Yeah, which is a huge drop.
But even more importantly, their cash burn plummeted. I mean, historically, they were burning through $15 million a quarter now. That is down to just $2 million.
$2 million, it's incredible. That is the magic of transitioning to an asset-light model. Now, to get there, they did have to take some short-term pain for long-term gain. On the balance sheet, they took a $5.9 million non-cash inventory write-off to clear out legacy stock.
Okay, let's pause on that because those accounting terms can get a bit dense. What does a non-cash inventory write-off actually mean for them in practice?
Good question. It basically means acknowledging that parts or older chargers just sitting in their warehouse are never going to be sold at their original value.
So it's like admitting you overvalued your garage sale items.
Basically, yeah. Under standard accounting rules, which is what GAAP stands for, generally accepted accounting principles, you have to recognize that loss. You take the hit on paper now to clear the decks.
Right.
And because of that $5.9 million write-off, their GAAP gross margin for the quarter was dragged down to a rather ugly 15.8%.
Ouch. But that is just a one-time accounting pain, right?
Exactly. It's a rip the Band-Aid off moment. If you strip out that write-off to look at the underlying health of the business, which is their adjusted gross margin, it actually hit a much healthier 37.8%.
Well, that's way better.
Yeah. And moving forward, they mentioned their goal is to maintain a, quote, right-size inventory of just $15 million on the balance sheet at any given time.
You know, it reminds me of a chef who realizes they are losing their shirt trying to run a massive 500-seat fine dining restaurant.
Oh, I like this.
Yeah, like the rent is too high, the utility bills are insane, the front of house staff is costing a fortune. So the chef just shuts it down, fires the wait staff, and rents a small space in a shared commercial kitchen.
Right, a ghost kitchen type of setup.
Exactly. You are no longer in the real estate or restaurant management business. You're just focused purely on making the best possible recipe. You let the kitchen owner worry about the oven breaking or the roof leaking.
That is a highly accurate analogy.
Yeah.
You shed the weight that doesn't actually add value to your core product.
Yeah. So Blink shed its factories because physical assets were dragging down their balance sheet. But what do you do if your entire business model is physical assets?
Now that is the paradox Brandywine Realty Trust is facing.
Right. Which brings us to the second phase of the playbook, pruning physical assets. Now, I have to push back here for a second.
Sure, go ahead.
Because if you read any financial news, commercial office real estate is supposed to be incredibly toxic right now.
Oh, absolutely radioactive.
Right. Post-pandemic, the narrative is that nobody is going to the office, buildings are sitting empty, and high-interest debt is just crushing the landlords. So how on earth is Brandywine managing to beat expectations with a $120.95 million revenue quarter and maintaining an 88.3% occupancy rate in their core portfolio?
It definitely feels like they're defying gravity when you look at the broader headlines about the office apocalypse, but you have to look really closely at the underlying mechanics of their pre-market Q4 2025 results.
Okay, walk me through it.
Let's start with the earnings. Their GAAP earnings per share, or EPS, beat consensus by 2 cents, but it came in at a loss of 21 cents a share.
Which to a casual investor sounds terrible. Losing 21 cents a share doesn't sound like a win.
It doesn't, no. But for real estate investment trusts, traditional EPS is actually a highly misleading metric. You really have to look at FFO, or funds from operations.
Okay, wait.
Yeah.
Brandywine's FFO was right in line with consensus at 8 cents a share in the positive. But break down why FFO matters more here. Why do we just ignore the traditional net income loss?
2 words. Non-cash depreciation. Under standard accounting, a company has to slowly deduct the value of its physical assets over time.
Like if I buy a laptop for my business.
Exactly. It depreciates over a few years until it's worth 0 on paper. Real estate rules force REITs to do the exact same thing with their skyscrapers.
Wait, really? Skyscraper depreciation?
Yeah, they have to deduct massive depreciation expenses from their earnings every single quarter. But unlike a laptop, a well-maintained skyscraper doesn't actually become worthless, right? It's still generating millions in rent.
Right, people are still paying to sit in it.
Exactly. So FFO adds that non-cash depreciation back into the equation, giving investors a much truer picture of the actual cash the buildings are generating.
Okay, that makes perfect sense. So the cash flow is stable. But what about the demand? Because they reported 157,000 square feet of leasing activity in their wholly owned portfolio in Q4.
It's a big number.
And they didn't just lease it. Their rental rate mark-to-market increases were incredibly strong. The transcript highlights they were up 20.9% on an accrual basis and up 10.0% on a cash basis.
Yeah, those are solid bumps.
But before we talk about why people are paying more, clarify the difference between those two numbers for us, the cash versus accrual basis.
Sure. The cash basis is the simplest. It compares the actual starting rent of the new lease against the ending rent of the old lease. So on day one, tenants are paying 10% more in actual cash out of pocket.
Got it. And the accrual basis?
The accrual basis is higher, nearly 21%, because it averages out the total value of the lease over its entire lifespan. So it accounts for built-in annual rent bumps and smooths out any free rent periods they gave the tenant up front.
Right.
But both metrics tell us the exact same story. Brandywine has real pricing power.
Which brings me back to my main question. How? Why are employers paying 10% more in cash for office space when the broader office market is practically crashing?
It comes down to a phenomenon called the flight to quality.
The flight to quality.
Yeah. In a tough economic market, Tenants abandon mediocre, older, Class B buildings. They know that if they want to entice remote workers back into the office, the physical environment has to be spectacular.
All right, you can't lure someone back to a dingy cubicle farm.
Exactly. So companies are consolidating. They might rent less total square footage, but they are willing to pay a premium for top-tier Class A spaces with prime locations and state-of-the-art amenities.
And Brandywine is aggressively leaning into this. They aren't trying to save every building in their portfolio. Just like Blink shed its factories to protect its core business, Brandywine is shedding underperforming Class B assets to protect its balance sheet.
Precisely. They actually gave guidance for 2026 stating they're targeting $280 million to $300 million in asset sales.
That's a lot of pruning.
It is. They are actively seeking to offload weaker buildings, specifically to reduce their corporate debt, alongside plans to recapitalize their Austin development joint ventures.
Because liquidity is survival. By pruning the weaker assets, they insulate the premium buildings. And it appears to be working beautifully.
It really does.
Yeah, I mean, they boasted on the earnings call that they have zero borrowings currently on their $600 million unsecured credit line, and they have no bond maturities coming due until November 2027.
That is a fortress balance sheet in a real estate sector where most companies are just drowning in high interest debt.
That's crazy.
It gives them a 2-year runway where they are not forced to refinance their debt at today's punishing interest rates.
Okay, so both of these companies have aggressively cut the fat. They have altered their structures. They have protected their balance sheets. But here's where it gets really interesting.
Because you cannot just shrink your way to long-term success.
Exactly. Once a company has saved the money and stopped depleting, how do they fundamentally change how they make money?
That is the pivotal transition from mere survival to sustainable profitability. And for both Blink and Brandywine, the holy grail they are chasing is identical.
Which is?
Transitioning away from unpredictable one-off transactions into high-quality recurring revenue.
Let's look at Blink's transcript first. They are making a massive strategic pivot away from just selling EV charger hardware to property owners, which is a low-margin one-off product sale.
Right.
And they're moving toward owning the chargers themselves to collect high-margin recurring service revenue. And the Q4 numbers show this pivot is taking hold, right? Their service revenue jumped 62% year over year to $14.7 million.
It's a huge jump.
Yeah, that service revenue now makes up 54% of their total revenue.
If we connect this to the bigger picture, you can see why the market heavily rewards this specific shift. Wall Street pays a massive premium for recurring revenue over one-time sales because it is predictable. Think about it. If you sell a charger to a hospital, you capture a small margin once. But if you retain ownership of that charger at the hospital and collect a fee every single time a doctor or patient plugs in, you've created a durable, multi-year cash flow asset.
And Blink is seeing immense growth in this specific area. Their DC fast charging revenue from their own locations grew over 200% in 2025.
200%.
Yeah. There is this incredible anecdote in the transcript regarding their partnership with Royal Farms convenience stores.
Oh, yeah. The Royal Farms data is wild.
Blink had a portfolio of chargers there that generated roughly $225,000 in revenue in 2024. In 2025, on nearly the exact same number of chargers, revenues spiked 300% to nearly $950,000.
And that is the crucial point. That spike wasn't because they magically deployed 4 times as many hardware units overnight. It was driven purely by higher utilization of the existing assets.
Right, but how does utilization jump 300% in 1 year just organically?
Well, it's a combination of factors. First, macro EV adoption is steadily rising, meaning more electric cars are simply on the road.
More cars, more charging.
Exactly. Second is network reliability. When drivers know a specific location has high uptime, meaning the chargers aren't broken, third-party routing apps direct more traffic there, driver confidence creates a compounding network effect.
Okay, that makes sense.
They are also deploying new 600-kilowatt ultra-fast chargers in the Denver area. These are designed for incredibly fast turnaround times. A driver can get a meaningful charge in minutes, not hours.
Right, meaning the station can cycle through significantly more paying customers per day.
Precisely.
It is a total mindset shift for the industry. You know, it reminds me of the whole planting flags concept.
Oh, right.
Because a few years ago in the EV space, the dominant strategy was just a land grab. The idea was build a charger everywhere you possibly can, and eventually they will come.
Yeah, just blanket the map.
But that era is completely dead. On the call, Blink's management explicitly stated they are refusing to chase what they called phantom segments.
I love that phrase, phantom segments.
Yeah. Instead, they are utilizing deep data analytics to find high-density EV markets that currently have geographic gaps, and they are only deploying capital into those specific proven voids. They aren't hoping for a market to materialize, they're targeting guaranteed utilization.
It is a highly disciplined approach to capital allocation. And ironically, Brandywine is executing the exact same philosophical strategy to secure their own version of recurring revenue.
Yes, Brandywine is actively buying out their partner's preferred interest in key Philadelphia properties, specifically the buildings at 3025 JFK Boulevard and 3151 Market Street.
Right.
By buying out those joint venture partners, Brandywine wholly owns those premium properties, and more importantly, they wholly own 100% of those reliable cash flows.
Which is absolutely critical for a REIT because their investor base demands a reliable, recurring dividend.
Right, they want that steady check.
Exactly. By consolidating full ownership of their highest performing Class A assets, Brandywine maintained a 100% FFO payout ratio in Q4.
Wow.
They are actively ensuring that the premium cash flow they do have is completely theirs, locking in that recurring revenue to keep their investors satisfied while they simultaneously sell off the dead weight in their broader portfolio.
So you have the macro structural changes, the balance sheet defense, the pivot to recurring revenue. But that brings us to the fourth and final phase of the playbook, which is all about the microeconomics of 2026.
Yes.
Now, I have to ask you about this because I was reading the Blink transcript and the CEO and CFO were talking about cutting costs on SIM card fees and optimizing credit card transaction processing. When a multi-million-dollar publicly traded company is hyperfixating on individual SIM cards.
It sounds a little petty.
Yeah. Isn't that just like auditing the company Netflix account?
Yeah.
Like, does that actually move the needle, or is it just corporate theater to impress analysts?
I completely understand why it sounds trivial at first glance. But at scale, it is absolutely the difference between operational life and death.
Really? SIM cards?
Yes. When you have already fundamentally reset your baseline costs, as Blink did by cutting their headcount in half and moving to contract manufacturing, the only way left to achieve true operational profitability is to optimize these micro inefficiencies.
Okay, so what exactly are they optimizing, below the surface?
Blink's management laid out a few key areas. They are aggressively renegotiating warranty costs with their suppliers. They are simplifying their payment processing architecture to shave literal pennies off every single swipe of a credit card. But perhaps the most financially impactful optimization is managing their energy demand fees.
Okay, let's pause on that because I've heard that term thrown around in energy infrastructure. What exactly is a demand fee and why is it so dangerous to an EV company?
Okay, so when you operate DC fast chargers, they draw an enormous amount of power from the electrical grid very quickly. Utility companies hit commercial users with demand fees based on their absolute highest peak power usage during a given billing cycle.
Okay.
So imagine a hot July afternoon. The grid is already stressed from air conditioning. If 3 cars plug into a fast charging station at 5:00 p.m., creating a massive sudden surge in power draw, the utility company might charge a massive premium penalty for that specific surge.
Like surge pricing on Uber.
Exactly. And that single penalty can completely wipe out the profit margin for that charging session, and sometimes for the whole week at that station.
Wow. Okay. So how do they fix that without just, turning the chargers off? Software.
Yeah. By using advanced energy management software to intelligently throttle and smooth out that power draw across the vehicles and optimizing exactly when and how they pull power from the grid, Blink protects their margins from being crushed by the utility's peak pricing.
Oh, that's clever. So it's not just auditing a Netflix subscription. It is actively saving the unit economics of the entire business model.
Precisely. When management models out the savings from the SIM cards, the cheaper transaction fees, and the demand fee software optimization, they expect it to result in 100 to 300 basis points of gross margin improvement in 2026.
And a basis point is 1/100%. So we are talking about adding 1 to 3 full percentage points of pure margin straight to the bottom line.
Yes. Without having to sell a single additional charger. That is literally the mathematical difference between bleeding cash and finally achieving operational cash flow break even.
And their 2026 guidance reflects that quiet, methodical confidence. They are targeting $105 million to $150 million in total revenue. But much more importantly, they are aiming for a 34 to 35% gross margin.
And what is fascinating is they have a massive $100 million backlog of projects sitting there, approved and waiting to be built.
Right. But notice their profound discipline with that backlog. Because, a few years ago, a startup would rush to build that entire backlog tomorrow just to show top-line revenue growth to the market, regardless of the cost.
Oh, absolutely. Growth at all costs.
But Blink is waiting. They're waiting for the right unit economics before they deploy their capital. They recently raised $20 million in what they called a clean, no-warrant deal.
Clean, meaning they didn't have to offer toxic, highly dilutive terms to desperate lenders just to get the cash.
Right. They raised that $20 million on favorable terms, specifically to fund 30 new DC fast charging sites, representing about 150 ports. They have the capital in the bank, but they are holding it tightly.
Yep, deploying it exclusively into those high-density, high-utilization gaps we talked about earlier.
So what does this all mean? When we take a step back and look at the blueprints, these two completely different companies are drawing up.
It's a clear picture.
Yeah, whether you are dealing with physical skyscrapers in Philadelphia or a digital network of EV chargers spreading across the highways of Colorado, the 2026 reality is exactly the same. The era of debt-fueled growth at all costs is completely over.
Long gone.
The winners right now are the companies practicing radical simplicity. They are shedding everything that isn't their absolute core competency. They are preserving liquidity and defending their balance sheets at all costs.
Right.
And they're focusing strictly on high-margin recurring quality, whether that is a premium Class A office lease in the consolidated market or a highly utilized 600-kilowatt charging station in a proven transit corridor. They are acting like the chef in the shared kitchen. Forget the massive real estate footprint, just perfect the recipe.
It is a phenomenal playbook for survival and sustainable profitability in a harsh macroeconomic climate. But, this raises an important question.
What's that?
Well, one that goes beyond just the next few quarters' earnings reports. If every company across every sector is currently adopting this exact same hyper-conservative playbook, if they are all cutting experimental projects, if they are strictly holding on to proven safe assets and obsessing over basis points on SIM cards, what does that mean for the future of bold innovation?
Oof, that is a chilling thought. If you are entirely focused on not failing, you might not be aiming for a breakthrough.
Exactly. If no one in the corporate world is willing to take a massive, inefficient risk anymore because the market violently punishes any cash burn, where do the paradigm-shifting breakthroughs of the 2030s actually come from?
Right.
You can optimize an EV charger's power draw or an office building's leasing structure to absolute perfection, but optimization doesn't invent the next industry.
That is something to really chew on. If everyone is playing it safe and managing basis points, the future might arrive a little slower than we all thought. Thank you so much for joining us on this deep dive. We hope this look into the universal survival playbook helps you understand the invisible financial forces shaping the companies around us, and maybe even gives you a new lens for your own business decisions. We warmly invite you to keep questioning the numbers behind the headlines, and we will catch you next time.